Good evening to all the members who have joined for this bank audit webinar of Central Statutory Auditors. I welcome the Central Council member, CA Ranjit Kumar Agarwal from Calcutta. I also welcome the chairman of SIRC, CA Chinnamma, who is presently now in Madurai. So I request the chairman of SIRC to welcome the chief guest, a speaker, and all the delegates who are participating in this webinar.
Thank you, Naresh sir. Our beloved esteemed member of the profession, CA Ranjit K. Agarwal ji, Central Council member, and beloved and energetic CA Dhananjay Gokhale sir, and resource person of this evening for event of SIRC, and my council colleague, Secretary of SIRC, C. Naresh Chandragalli, and my other colleagues in the regional council, my dear elite professional fraternity. Very good evening to all. As we all expected, our beloved past president, CA Amarjit Chopra ji, is supposed to be graced this occasion today, as he was informed about his Viva, which is a part of his doctorate program. At a very short notice, he could not make join, but as the latest communication by the Amarjit Chopra ji, he will try to join between this program. Members, I am extremely pleased to be with Ranjit Kumar Agarwal ji and CA Dhananjay Gokhale ji, and the two eminent and par excellent personalities in the field of the bank audit, and who have made immensely contributed and shared their knowledge and the wisdom with our professional fraternity over the years for the overall development of our profession. I am also extremely delighted to be in the company of my colleagues in the regional council and a large gathering of professional colleagues, of course, through this virtual platform. I deemed it is a great honor and privilege to pleasure to perform the most cherished role of extending the warm welcome on behalf of the SIRC and on own behalf of to the resource person, my colleagues in the regional council, and to the participants of this seminar on the Central Statutory Audit of the banks. Members, this morning I attended the bank audit seminar organized by Madurai branch of SIRC with a physical presence of members. The one-day program was attended by a large number of the members. Members, first of all, I express on behalf of SIRC and on my personal our sincere thanks to Ranjit ji and Gokhale ji for accepting our request to address all the members and share their precious time to share their experience and expertise knowledge. When we were in the process of structuring the program, we received excellent support and the encouragement when we approached the eminent speakers of today. I also feel privileged and extend our warm welcome to the delegates to this program. This seminar is a way unique where the delegates have wide exposure in the field of the bank audit. Therefore, I am sharing my thoughts by the renewed faculty coupled with the interaction with the audience would bring a newer thoughts and insight into the issues of the Central Statutory Audit of the banks. I am therefore confident the proceedings of these two technical sections would be very lively and enriching. Members, there has been a paradigm shift in the approach of the bank audit, whether it is a bank branch audit or central statutory audit, as with the technical advancements, where has been many areas which need through the verification that chartered accountants have to make it. I take this opportunity to request the central auditors to find a way out taking up these issues with the management to have ample time for both the central statutory and the branch auditors. The topics that are being dealt with today covers most of the important aspects of the bank audit and also assume greater significance in the light of the high expectation from the government and the public and other stakeholders. CA Dhananjay Gokhale, the other resource person, would take this audience through the regulatory compliance with reference to Treasury Audit and capital adequacy norms. Will provide us with a his insight on the compliance procedures and process on the Treasury Audit and capital adequacy norms. I am sure his address will generate significant thoughts to process approach to the issues by the central statutory audit of the banks. The skill sets required for the central audits a greater importance as the central auditor are expected to perform at the highest standards by the central audits by the RBI and SEBI. I therefore the view that seminars of this nature and magnified with significantly help the members to render high value the professional service in the field of bank audit. I am feeling gratified for their insight, acceptance, and extensive address for the making this evening worthy to time spent with the participants. I hope the resource person would have also enjoyed the day in the company of August presence of elite professional fraternity through the virtual. Before I conclude, I would like to inform the members that in the recently last month, SIRC brought out an e-publication and hosted in the SIRC website titled as Central Audit of the Banks Beyond a True and Fair, authored by CA PM Veeramani from Cochin. Members may access the book from our SIRC website, that is www.sirc.ica.org, and get the benefited. With this reference and observation, I once again extend warm welcome to the resource person, to my colleagues in the regional council, and all the participants. Thank you all. Thank you once again.
Thank you, Chairman, for giving a welcome message to all the members. We have two topics being discussed today. First topic is Code of Ethics relating to bank audit, and the first session speaker is CA Ranjit Kumar Agarwal. Second topic is on overview of regulatory compliance with reference to Treasury Audit and capital adequacy norms. And we have invited CA Dhananjay Gokhale from Mumbai. Dhananjay ji, first we'll request Ranjit Kumar sir to address, and your session will be second. I think it's okay. Yeah, so members, it's a privilege for me to introduce the first session speaker, CA Ranjit Kumar Agarwal ji. CA Ranjit Kumar Agarwal is a chartered accountant in practice since last 20 years. He's a company secretary at DISA from Institute. He was the chairman of EIRC during the period 2013-14, and the EIRC got the Best Region Award during his chairmanship. So after that, he got elected to 23rd, 24th, and 25th Central Council of the Institute of Chartered Accountants of India for 3 terms in a row. As a chairman of Banking Professional Development Committee of ICAI, he has implemented bank branch audit software, which is being implemented now by all banks across India. He has conceptualized and implemented UDIN as a chairman of PDC, a landmark reform of ICAI. Presently, he is a convener of group constituted to implement UDIN concept in all SIRC countries, which is being coordinated by him. As a chairman of Ethical Standards Board of ICAI in 2019, he has revised the Code of Ethics after a gap of 10 years. He is currently the chairman of Committee for Members in Industry and Business and Tax Audit Quality Review Board of ICAI. He is a regular speaker on the topics of Code of Ethics, professional opportunities, student motivation sessions, and socially, he is also active in Lions Club, Bara Bazaar Library, JCI, French Tribunal Society, to name a few. With this very brief profile, I welcome CA Ranjit Kumar Agarwal to address the members on Code of Ethics in bank audit. Welcome, sir.
Thank you very much, Naresh ji, Secretary of SIRC, for the kind words for me. Very respected Chairman of this SIRC, China Mastan ji, immediate past Chairman DC Jain, Dhananjay ji Gokhale, very resource person as far as bank audit is concerned. All the guidance note and whatever banking related issues are there, he is the person Institute always looks for. And all the learned participants, and auditor of this conference. Good afternoon to all of you. We are going to discuss some of the relevant aspects of the code of ethics which are applicable to the audit. There cannot be a separate ethics for bank audit, but since you are going to do the audit of the banks in the next 1 month, so we should know what we are auditing, why we are auditing, and what are the precautions, what are the do's and don'ts you should do as an auditor. And Institute of Chartered Accountants India has already issued guidance note on the bank branch audit is already issued, and you must go through that guidance note because that guidance note is very, very helpful while conducting the bank branch audit. So let's start with some of the issue of the code of ethics, which we are going to discuss in next 30-40 minutes. Friends, ethics is not a subject which is a new to the profession. Before 1949 also, after 1949 also, we are used to practice the ethical conduct while discharging a duty. But in the 1963-64, first time, our institute has presented a document, a paper on a documentary code of ethics, which was introduced first time in the council. And while introducing that code of conduct, which that point of time was called code of conduct, the then president R.C. Cooper sir, he has said that in the larger interest of the institute, in the larger interest of the institute, the council exhorts all members to search their hearts and conscience whenever they are in doubt, and thereby assist towards the maintenance of high principle of professional conduct established by this council. So the expectation of the council that the members should conduct themselves in the highly ethical way while discharging their duty as a practicing CA. We have seen that ethics is a state of mind. That's why a professional skepticism word has come, where you have to take the professional judgment. Many times things are ethical but not legal. There are many instances we have seen something is legal but not ethical. So you have to apply your professional mind, how something is legal and not ethical, how to conduct yourself while discharging your duty. Of course, ethics is lawful, at the same time it's awful. And why we are called professional? It is a well accepted principle that the professional are, whenever they are interested with some duty, then the entire stakeholder trust on them. And why we are called professional? Because why we are not called businessmen? We are called professional because we have our code of conduct. And the second point, we work towards the society and the masses and the stakeholder gain, and our personal gain takes the backstage. So whenever we are discharging our duty, we don't do for the personal gain. When we discharge our duty, the stakeholder gain, the society, the government, the regulator, these stakes are prime importance to us instead of the personal gain. And when this ethical things were established by the council, because we have the history of ethics that 1963 code of conduct started. Now 2019, we have aligned our code of ethics with the international code of ethics. We have 180 country accounting body across the world, where all the country have their own code of ethics. And you will be surprised to know that when we have redrafted our code of ethics, we found that in many aspects our code of ethics are more stringent than the rest of the world. And in 1975, Institute of Chartered Accountants India established a ethical standard board, a non-standing committee. In 1976, 1 year after, International Federation of Accountants established the International Ethical Standard Board of ISBA. So literally, as far as ethics is concerned, India has always taken the lead while formulating all these principles. So in our case, in India, we statutory auditor cannot become the internal auditor. But in other countries, these kind of restrictions are not there. We are not allowed to charge fees on the contingency in nature or percentage wise, with some exception. But otherwise, other countries, these kind of restrictions are not there. We have our own management consultancy services, advertisement guideline, logo guideline, website guideline, UDIN guideline. So many guidelines we are formulating from time to time by the council. Rest of the world, other countries, these kind of things are not there. So in many aspects, our code of conduct are more stringent than the rest of the world. Globally, entire ethical practice is based on 5 fundamental principles, that is integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. These are the 5 pillars on which entire code of conduct is based. That's why they are called 5 fundamental principles. When you compare our code of ethics, new code of ethics, which we have formulated from April 2020, where we have said what are the expectations of from the auditor, by the stakeholder, by the institute, and by the regulator. So our code of conduct are very clear. They are saying the professional accountant should be honest and competent. They should be honest and competent, and they should not associate themselves with any misleading or fraudulent information. So these are the one principal factor that is expected from the professional accountant. They should be innovative and adopt the technology whenever it is demanded. Whenever new things are coming, they should be adoptive in nature, and they should continuously learning themselves for skilling and upskilling themselves. That's why CP, our concept came in our institute. You have to continuously upgrade yourself with the fast changing world. And third one, you should not work under any undue pressure. And whenever you are seeing any or witnessing any illegal or illicit behavior, you cannot turn a blind eye. You have to be vocal, you have to advocacy, all these things. So these are the 4 or 5 fundamental things which are expected from the auditor. They should be honest and competent. They should not associate with the misleading information. They should be innovative. They should adopt the technology continuously. They should upgrade themselves, and they should not work under any undue pressure. So these are the, if you go through our code of conduct, these are the highlights of our code of conduct. We have 2 schedules. If you go through the Chartered Accountant Act, we have 2 schedules, Schedule 1 and Schedule 2. Now, Schedule 1 talks about 19 clauses. And what are these 19 clauses? These clauses talks about the conduct or misconduct of the member, which are affecting the member inside the fraternity. Outsiders are not involved, only members inside are affected, like you have not communicated with the previous auditor, or you are sharing the fees with the non-member, or you have taken a non-member as a partner, or you are involved in the solicitation or advertisement guideline you are violating, you are charging the fees on the percentage basis. All these clauses are covered in Schedule 1, and that's why this Schedule 1 has been bucketed, which are affecting the fraternity inside. And there is a section 21 which talks about Board of Discipline. It's a 3-member bench. 2 are council member, 1 is government nominee. Now this 3-member bench has the mandate to decide on the outcome of the conduct or misconduct of these 19 clauses. And they have been entrusted with 3 measures. They can either reprimand you, they can remove your name from the register of member for maximum 3 months, starting from day 1 to 3 months, or 1 lakh rupees monetary penalty. So these are the mandate has been entrusted to the 3-member BOD as per section 21 of Schedule 1. Now come to Schedule 2. Schedule 2 talks about these 15 clauses of Schedule 2 talks about those conduct which are affecting outside the fraternity. Like outside the fraternity where stakeholders are affected, regulators are affected, shareholders are affected, or government is affected because of the conduct or misconduct of chartered accountant or professional accountant. If outsiders are affected, these kind of issues has been bucketed in Schedule 2. And since these Schedule 2 conduct are more grave in nature from Schedule 1, so here the section 20 talks about a disciplinary committee, and this disciplinary committee comprised of 5-member bench, 3 are council member and 2 are government nominee. Now this 5-member bench has given the mandate to decide on the outcome of the conduct or misconduct of our member in these 15 clauses. They have again given a 3 power. Either they can reprimand you, they can permanently remove your name from the register of member. Twice in the past, twice in the 2 occasions, some name of the members were permanently removed from the register of member, and 5 lakh rupees monetary penalty. So this Schedule 1 and Schedule 2, this 19 plus 15, 34 clauses are code of conduct is nothing but about the commentary of these 34 clauses, what you can do and what you cannot do. In addition to that, the various guidelines framed by the council from the time to time. So this code of conduct is nothing about this 34 clause commentary plus various council guidelines. If you see the new bill proposed in the parliament, these monetary penalty and the imprisonment or the removal of this membership has been increased manifold. Now they have proposed from 1 lakh rupees to 10 lakh rupees, from 5 lakh rupees to 50 lakh rupees. They have also included a imprisonment angle also. Right now there is no imprisonment here. They have also included it. So this penal provision has they are more stringent in the new chartered accountant bill, which is pending in the parliament and is referred to the standing committee of the finance. So when we are talking about the code of conduct or code of ethics, these 34 clauses are very, very important while discharging our duty. In addition to that, our code of ethics has 5 kind of threats. Now, when you are discharging your duty as a professional accountant, you come across many kind of threats. Whether these are threats, you can go through all these threats. These are affecting your judgment while discharging your duty or not affecting that professional judgment you have to take. They have quantified what kind of threats can be: self-interest threat, self-review threat, advocacy threat, familiarity threat, and intimidation threat. So what is the self-interest threat? Suppose in a tender document, you are quoting very, very low fees in which you are aware that you cannot do justice of compliance of the various accounting and auditing standard as expected from that assignment. Still you are quoting very low fees. It is a case of self-interest threat. You have a very close relationship with your audit client, 30, 40 years. So this is also an example of self-interest threat. You have purchased a joint property with your audit client and the financial impact is there. It is a case of self-interest threat. When you are in new code of ethics, we are saying the audit fees is unpaid. So when the substantial part of the audit fees is unpaid and then still you are continuing as an auditor without getting the fees of the previous year, it is a self-interest threat. How to mitigate this threat we will discuss. Then self-review threat, they are talking about when you have developed some software for a client and now the reports are generated from that same software and now you are auditing the same books of account which has been generated from the same software which you have implemented in that organization. So this is the example of self-review threat. Advocacy threat talks about when a particular section or a clause or a provision is affecting your client and you are lobbying with the government to remove that particular section, clause or provision, then it is a case of advocacy. If the institute or a regional council or a study cell can represent, that is a different issue. But you as an auditor, if you are representing to the government for a removal of something or amendment in something, since that is affecting directly to your client, audit client, it is a case of a advocacy threat. A CA may be asked to promote clients' security as a IPO. So if you are an auditor of a company and you are promoting the IPO of a client, it is a case of advocacy threat. Familiarity threat talks about the spouse of a CA is in a senior position, the CEO or CFO, and you want to do the audit of that company. This is the familiarity threat example. Your firm has, your partner has resigned from your firm, and now he has joined a senior position in a company. And now you want to do the audit of the same company where your ex-partner has recently joined. This is the case of a familiarity threat. In various occasions, birthday, anniversary, Holi, Deepavali, you are accepting some gift from your client where amount is very, very substantial. Our code of ethics says it's a familiarity threat. As an institute, as a auditor of a company, if you are taking a sponsorship from your audit client for some event or some program, this is also a case of familiarity threat. Intimidation threat here, as far as bank audit is concerned, suppose you want to do or classify a account as a NPA, and you are getting pressure from the journal and the head office that don't do it, otherwise you will not get the bank audit next year. So whether they are in a position to give you the audit next year, that is a different issue. But if you come to the pressure and you don't classify this account, which is supposed to be NPA, then it is a case of intimidation threat. So if you are working under a undue pressure or some other influential people are pressurizing you not to discharge your duty, which you are expected as a professional accountant, this is the case of an intimidation threat. And safeguard. Now our code of ethics talks about various safeguards. These 5 kinds of threats are there. Now how to safeguard your interest and the others' interest. So first you have to identify the threat. Whatever threats is there, you must know this is the threat. Now you should try to eliminate or reduce this threat so that it can come to the acceptable level. Example hereby, that suppose your ex-partner has joined a company in which you want to be the auditor. Now initially, if you don't do the audit for next 2 years, and from the 3rd year onwards you want to do the audit, so you have tried to reduce the threat to the acceptable level. There are so many examples of reducing the threat to the acceptable level that in the case of a board meeting, you want to join a company or board meeting as an auditor in Goa or any location, and you want to take your spouse along with you on the expenditure of the company. Now, if you pay the expenditure of your spouse and take along with you, then you have reduced the threat to the acceptable level. So you should identify the threat. You should try to reduce the threat to the acceptable level. If you are not able to do that, you should consult our ICAI. The professional accountant should consult their alma mater, their professional institution. These are the issues I am facing, what to do. So the institute will also guide you how to reduce the threat. And if you are not able to do all these things, then you have to withdraw from the assignment. So these are the safeguards has been mentioned in our code of ethics as a various threats. Then a new things has come from our institute that once we have revised our code of ethics, which is applicable from July 2020, there was a part A and part B of code of ethics, which we have converted into part A become volume 1 and part B become volume 2. So what is this part A? Part A talks about our code of ethics, which we have aligned with the international code of ethics and applicable to our member, which we have renamed as a volume 1. Part B talks about various 34 clauses of the 2 schedules along with various guidance note or guideline issued by the council, which we have renamed as a volume 2. Now volume 3, a new case law referencer we have launched last year. This is the from 1949 to 2019, last 70 years. We have identified 484 case law which has been pronounced by the council, high court and supreme court for the member, and all these 484 important case law we have classified, reclassified, schedule wise, clause wise, and put in this booklet. And one case law, one paragraph crux we have given. So if you come across any kind of confusion while deciding or while taking a decision as a professional accountant, what to do, not to do, you can refer those kind of example, because the same example you can find in the book where council has decided something. Suppose you want to don't want to pay the stipend to the article, so you can see in that booklet what is the council view if somebody not paying the stipend to the article. What are the repercussions? What are the penal provisions? Suppose you have not taken prior communication from the previous auditor while accepting or while doing the audit of a new company. So if you have not communicated with the previous auditor, what are the repercussions? You can find in the booklet. So this volume 3 484 case law one paragraph, one case law is very, very beneficial to all practicing member. It should be in the table of every practicing member. Whenever they are feeling any difficulty, they can refer the case law and they can discharge their function accordingly. In this new code of ethics, administrative service function, administrative services paragraph we have deliberately added. Although you are already permitted while doing the audit of a client, the taxation and other aspects you are permitted to do. These are not considered as a non-audit service, but these were not specifically mentioned. Now we are saying that if you are an auditor of a company, then the routine work, mechanical work, which are day-to-day operation of the client, if you are extracting the data from those clients and uploading with the various regulator with your digital signature, these kind of services are called administrative service, and you can very well do along with the audit of the same company, like filing of the TDS return, GST return, income tax return, ROC return, all kind of service where professional judgment is not required, just collecting the data and uploading to the server of the regulator. So these kind of services are permitted. So we have now written all these things in black and white that these are permitted to all practicing CA, these kind of services. Taxation and fees, these have already been now come from 1st April 2022. For to understand all this fees aspect and this taxation aspect, we have to take a separate session. Today we will not discuss, but the most important part of this discussion today is the NOCLAR. Now this NOCLAR is now applicable to all practicing CA from 1st April 2022. So in this bank audit, this NOCLAR is applicable. Now what is this NOCLAR? NOCLAR is a non-compliance with laws and regulations. So when there are laws and regulations which has direct effect on the material amount and disclosure of the financial statement of a client, there are other laws and regulations which are not directly affecting the financial statement as far as amount and the disclosure is concerned, but they are very, very fundamental to run that company as a going concern. So there are laws and regulations, there are other laws and regulations. We in the institute already have SA 250. SA 250 talks about laws and regulation in audit of financial statement already from 1st April 2009. But in addition to that, this new non-compliance with laws and regulation section has come to the practicing member. Now, what is this other laws and regulation or laws and regulation when section SA 250 is already there? You should be proud that in the accounting profession, we are trusted to act in the public interest, because we are the only professional of India, I can say like this, where public has a repose their trust in us. So whatever we certify, they accept it and they act accordingly because it has been audited by a chartered accountant. So once the public has a huge trust on the signature of a chartered accountant, then the accounting profession, we are trusted. So if we are trusted to act in the public interest, then we are expected to qualify or disqualify or give our comment on the various laws and regulations complied by that organization or not. So right now this NOCLAR provision is applicable to only public interest entity. So bank is a public interest entity, number one. It is applicable to only on audit assignment. So this audit part, statutory part of the banking sector is very well covered in this NOCLAR. And this, the beauty of this NOCLAR is it is equally applicable to those chartered accountants which are working in the industry at a senior position. And if they are also not complying the various laws and regulations in their own company, they will also be subject to this NOCLAR provision. So we are not discussing right now that part. We are discussing only the practicing CA part. So what are the examples of NOCLAR? When in the course of the audit, if you come across various non-compliance in the entity of the various laws of the land, suppose some fraud, corruption is going on, money laundering, terrorist financing is going on. Securities market and trading option, insider trading is going on. Some banking and other financial product service, some problem is going on. Some data protection issues is there. Some tax avoidance and tax litigation issues is there. Environmental protection law is not complied with, or public health and safety issues are also there. So it's an entire, this NOCLAR is covering not only the financial legislation, but non-financial legislation also. If the, because of the conduct of the company, the environmental is getting polluted, or the public health or safety issue is there, that aspect is also expected to be covered by the professional account through this NOCLAR provision. And when you come across these NOCLAR provision in any entity as a listed company, then you have to bring these facts to the management. Now they are talking about compliance of the various laws and regulation and suspected non-compliance. If you also see there is a possibility that some laws and regulations are not able to be complied by the management, then so they have defined the hierarchy of the management also. First the management, then those charged with the governance. So if you are coming across any kind of non-compliance in the entity, then you have to bring this fact to the management. If management does not listen to the those charged with the governance, and if also they are not listening, then you have to bring this fact to the respective regulator. So there may be a issue where the chartered accountant working in that entity are not discharging his or her duty as he or she was expected. So you can complain to the ICAI in that regard. If the listed company issues are not in line of the SEBI Act, you have to complain to the SEBI also. If there is a likely that some public health or safety issue is there, then the respective regulator or environmental issue is there, that you have to also bring these facts to the respective. So they have also given the example of the regulator also, whether it's a SEBI or a ICAI or Environmental Pollution Act, or there are so many criminal or professional liability issues there. All these things are mentioned in our NOCLAR issue. So my request to, since this is a new law and from 1st April 2020 it is affected and this is implemented, so while doing your bank branch audit or bank audit, all these things you have to keep in mind while discharging your duty. There are some other issue in the bank audit like LFAR. Now, Institute of Chartered Account Ethical Standard Board already decided last year that the concurrent auditors should not sign the LFAR. So those kind of branches, those kind of branches which are not subject to audit, in those branches, concurrent auditor can sign the LFRA. But those kind of branches where already statutory audit is there, in those branches, LFRA should not be signed by other, that should be signed only by the statutory auditor. There are UDIN issue also while discharging the duty. If you come across any certificate report where UDIN is not there, then it's a serious kind of fraud is going to take place in that organization, and it is your duty to verify, certify whether that certificate or a bank statement or a balance sheet or a financial statement signed by other concurrent auditor or a revenue auditor or other management, UDIN is there or not. Because we have received many complaints from the banks that some of the certificate is given by the chartered accountant without the UDIN. And when we have verified, like from the Maharashtra, last week we have received 18 certificates from the Bank of Maharashtra, that whether verify these certificates are not giving a UDIN number, although it is signed by a CA. So when we have gone through those 18 certificates, we found that out of 18, 12 certificate, the name of the member is there, but they are not the member of the ICAI. 4 of them are not having the certificate of practice, they are the member, and 2, their membership is suspended. So when we have gone through these 18 certificate given by the Bank of Maharashtra to the ICAI, where 700 crores of fund is certified by those auditors, It's a huge fraud. Huge fraud is going. And that's why, because of this UDN, some savior to the profession has come, that those kind of person, those non-CA or the fraudster, are signing and certifying whatever they want, getting the loan sanction, and later on it was found that that person was not CA. Now it can be prohibited at the initial level, because without UDN, banks are not accepting those kind of certificate or report. Even if some frauds is going on without UDN, they are accepting. If you come across while doing your duty, then you should highlight or bring to the knowledge of the ICAI and mention your report also. There is many examples we have seen. You have not done your duty properly, and you are supposed to make one account NPA, but you have not done it. After 7 years, the RBI has written a letter to then auditor that in that year you have not make this account NPA, please explain. And when the auditor is not able to explain, the RBI has referred this matter to the disciplinary. So there are many cases in the disciplinary committee where the auditor of the banks has not done or discharged their duty properly, and after 5, 7, 8 years also, those cases are coming for the disciplinary action by the ICAI, by the RBI. So when you are doing or discharging a duty as a professional accountant, you cannot afford to you cannot now afford to be negligent. That time is limited, what to do, how to do, because within a given time you may say that time is limited, but if you are taking the time and you are discharging a duty with the full 100% checking, the bank cannot pressurize you to complete in haste. It is your duty, it is your power, that how much time you take to complete the assignment, irrespective of whether you are checking 100% or 10%. So in my opinion, whether articles are doing, staffs are doing, you as a auditor, when you are putting your signature, you should ensure that no amount of fraud or mistakes or negligence is there while discharging them. We have proposed in the banking RBI that we allow us in MEF that a column should be there, how many MOC or a fund diversion issue auditors are doing. They should incorporate in MOC to the MEF, and we should compile and give to the bank or RBI. See, look, this year our member has done so and so MOC, so and so divergence of fund, and these are the qualification made by our member. Because the government thinks we are not, the audit of the bank is not required at all. In the bank branch audit, the government is of the opinion gradually it will go. This will be wiped out from the system. Bank branch audit will not be longer in next 4 or 5 years, because they are thinking that central auditor or a head office auditor are able to do with the systems, because the records are digitalized, the sanction is zonal office, branch level no power is there, so no audit is required. But once you do the audit and various financial scheme, this populist scheme given by the government, and the banks are disbursing the fund, and when you bring these issues in the report, there's here so many schemes, the fund is given, social scheme, populist scheme, and these all are accounted NPA. When you are bringing this issue, then it will be eye opener to the regulator, to the policy maker. No, audit is required. In Mudra loan, we have seen all Mudra loan, most of the loan are NPA. Now, whether it will come back, how it will come back, who will monitor? So it is the duty of we auditors, while doing this audit, how to see all kind of loan disbursement, how they are coming back to the system. If we are not giving this data in our audit report, the relevance of bank branch audit will go away in the next 4 or 5 years. There are many cases we have also seen where communication with the previous auditor issue is there. In those cases, in the banking audit is concerned, we have given our code of ethics that when the time is limited and you have to give the consent to the banks that you are accepting, so you have to give the consent with a disclaimer. You have to give your consent with the disclaimer you are accepting this bank branch audit subject to the communication with the previous auditor, which you can take later on, and then because there might be a situation where the previous auditor fees are not paid, and the previous auditor has already made a complaint to the bank or to the ICAI, which you are not aware. So in those cases, you will be held guilty of professional misconduct if you are not communicating with them. So in the case of communication with the previous auditor, clause 8, part 1, schedule 1 specifically says you have to communicate with the previous auditor irrespective of the assignment you are getting, whether it's a concurrent audit, revenue audit, management audit, tax audit, statutory audit, any assignment you are getting, you have to communicate with the previous auditor. So that aspect you should also keep in mind while discharging your professional thing. And UDIN, just would like to tell you again that UDIN, we have already communicated in our FAQ that uh, per assignment, per signatory given at a time, you have to generate UDIN. So if you are signing at one place various kind of certificate in the branch premises, you can generate one UDIN. But if another partner is signing later on, then he has to generate another UDIN. So if you go through the FAQ of the UDIN, per signatory, per assignment given at a time, you have to generate UDIN. So these are some of the issues or the ethical aspects of the bank branch audit. There are many issues. Which we have encountered through UDI now, that the how audit is done, where frauds are taking place, how this projected and the estimated and the provisional balance sheets certified by CA are being used in disbursement of the loan. And once you go through all these provisional and the prospective financial statement, and that has been signed by a CA, then this is also a misconduct on the part of the member. Because once you talks about the provisional balance sheet or a prospective balance sheet, we have already a standard SAE, Standard of Audit and Engagement 3400, which talks about the provisional balance sheet. So you as a auditor, as per various clauses of the Act, are not permitted to sign the provisional or prospective financial statement. But Institute has given you two standards, SAE 3400 and SRS 4410. If you are certifying those statements based on these standards with the audit report format given by the ICAI, then you are safe. But without that format of this audit report, if somebody is signing abruptly without giving any disclaimer, this is also a case of professional misconduct. And while doing your audit, if you come across the disbursement of the loan based on the provisional and the prospective financial statement, you should bring to the notice of the management, and in your report you should qualify all these things, because these two aspects are very, very important while doing the bank branch audit. Because we have seen number of cases where bank manager insists that these documents should be audited by a chartered accountant, but when we ask the RBI whether these are supposed to be signed by, so the Banking Regulation Act is silent. They are saying that there is no such provision in our Banking Regulation Act that these has to be signed by, because these are the management paper. Provisional balance sheet or a prospective statement is not the auditor's paper. These are the management paper. So you should be very, very careful while dealing with all this kind of document while discharging your duty. So there are so many issues in bank branch audit. Time is not that much, so we can discuss. If you have any query or any question is there, I will be happy to answer. Thank you very much with this small introduction. Thank you very much.
Thank you, Ranjit bhai. I am hearing you.
Yes, sir. We have Amarjit sir joined from his mobile, sir. So his video is not visible. So he has joined 20 or 30 minutes back, sir, for information.
Oh, sir is there. Sir is there. Oh,
yeah, yes,
welcome, sir.
Yes,
Oh, welcome, sir.
I'm hearing you. I must say, Ranjit, it has been a wonderful exposition. Frankly speaking, you have covered almost every area of the Code of Ethics. My only concern and my only request to all my colleagues who are there as auditors of the banks, whether branch auditors or central auditors is, please do not go to any of the bank managers at any point of time, कि भैया, that I want a loan for my client, or I want any assignment for any of my friends, or I want any assignment later on. I think that is the biggest problem today. And I can also tell you there are now cases where the same thing has been recorded by the branch managers on the telephone and has been then used against the chartered accountants. So my request is, because number one, we cannot solicit the work, and number two, if I'm trying to influence the branch manager simply because I'm the auditor of the whether of the bank or of the branch, I think this is absolutely in contradiction to the code of ethics, and this needs to be avoided under all circumstances. I think your point on, particularly your point on Udin, my only humble submission is that if at all the institute has collected this information.
So sorry, it seems his audio got muted. He need to unmute himself, sir. Sir, you're not audible, sir.
He's traveling. That's why maybe.
Yeah, maybe that might be the issue.
Humble
He has joined.
submission to you.
Yes, sir.
That's my humble submission to you. Somewhere or the other, we need to take action against those members. And we need to bring it to the knowledge of the various authorities that we are really taking action against such people. And so far as this prospective information is concerned, I think we have been taken for a ride by the clients. Believe me, I cannot do it. And wherever I even sign compiled from books of accounts, you have very rightly referred to 4410. We are not compiling anything out of that. And we still continue to do it. My request to every member is that if at all during the course of the branch audit, they come across any of the financial statements which have been signed like that, say that we ignore this particular statement. Why should we take care of that? And if the UDIN is not there, please bring it to light. And this can be a case of a fraud. And probably I may stand to be corrected, whether Naresh or anyone else can correct me, or you can correct me. My appointment letter from the bank very clearly says that if you suspect a fraud in any of these situations, you may report it directly to the Reserve Bank of India. Should I be doing it or should not I be doing it? I think this is $1 million question that we'll have to answer in the times to come to ourselves. So I will not like to take more time, because the time was up to 6 o'clock only, and I got free much later actually from there. The Viva went on for a much longer time than what I had expected, basically. So I'm on my way back. But I must compliment Ranjit, you, for a wonderful exposition of the entire subject. Thank you very much.
Sir, if you want to add something, sir, please add.
No, I think you have already touched upon communication. You have touched upon the 4410. You have touched upon the NOCLAR, etc. And I have touched upon, I did not know whether you had touched upon this relationship with the branch manager and the auditor, very frankly, and seeking assignments. I think, and I can tell you one of the cases which I have gone through as a board member of a particular bank, where the central auditor had gone and done something which was absolutely undesirable. And particularly, um I don't want to discuss even that particular case. And we have to be very, very vigilant with regard to our TADA bills. Believe me, this is one area of concern to the banks, to the Reserve Bank of India, to everybody. We need to be extremely careful about. So, I personally feel that another area of concern is that we have got certain long form audit reports which have not even been absolutely blank information. There is no information at all. Yeah, we have gone through those long form audit reports also. And when you compile the information in long form audit report, I think as a matter of code of ethics, because you have to exercise your due diligence on all those subjects. So because as per the schedule 2, we are supposed to exercise the due diligence, the schedule 1 part 2. We must exercise due diligence wherever I'm carrying out a particular work. that whether that information is correct or not. If that information is wrong, how can I accept that particular information? I think that's very important. So when I talk of code of ethics is all schedules, and we must take care of all those schedules. Basically, it is not merely connected with the communication. I think when I talk of gross negligence, due diligence, etc., I have to be absolutely sure as to what I am doing in a particular assignment. And now, with whether you are a central auditor or you are a branch auditor, your responsibility has gone up many times, believe me. In the recent case where Supreme Court or High Court has held that where the figures were inflated in the case of the stocks, and the auditor assigned the balance sheet, the auditor can be imprisoned. And they have ordered for the imprisonment of that particular chartered accountant, believe me. And now, with the requirement coming in CARO, and of course the management has to certify it in Schedule 3, this particular information with regard to the debtors and with regard to the stocks, we will not be able to get away with. If the information which is being filed with the banks, I'm not talking what is happening in the companies, but the information which is being filed with the banks, and I'm the branch auditor or I'm the central auditor, and that information is totally inconsistent, basically, with the balance sheet or with anything, I will be held guilty. Let's be very clear. My code of ethics requires that I should actually get into that particular part. Unfortunately, we have been ignoring asset 240. We have simply been saying that if I stumble upon an information is there. I'm stumbling upon, but I'm not even looking at that particular information. That's the unfortunate part. And that is where you very rightly said, I have heard that particular statement of yours. If we don't improve our branch audit working, branch audit will remain or not? It is $1 million question. Let's be very clear about it. I think we have been ignoring so many things in the restructuring. We have been ignoring so many things in the compliance with the terms and conditions. We have simply been turning our head the other way around, basically. We will not be able to do that in the times to come. And if we do that, I think the regulator is not going to take it kindly. Let's be very clear about it.
Very true, sir.
Sorry to the organizers that I was late, but I had no choice. But I still told Ranjit that if at all I can join at any point of time, I will like to join. Now I'm on my way to Delhi, may reach by 10:30 or so. But I thought that even if I can hear Ranjit for 15 minutes and can share some of my views, let me share that.
Okay.
I shall unmute.
It's very nice of you, sir, for joining this session and addressing along with Ranjit ji. So thank you very much for sharing your ideas and thoughts about this central auditors and the role of bank audit. I would also like to thank CA Ranjit Kumar Agarwal ji for taking us through the code of ethics relating to bank audit, and he's very clearly mentioned our role and taken us through various aspects of code of ethics and the type of situations we face through. Definitely, yes, the banks put pressure to us. After 3-4 days, you start getting calls from levels higher. So definitely there are issues. I'm sure members would definitely ensure they don't make they don't fall prey to those sort of pressures, and ensure that they comply and conduct the audit in a professional way. He also mentioned very important thing as relating to compilation of cases, 484 cases. I think that was a wonderful compilation, sir. I'm sure it would be a very important thing for all the members to go through. Also, he gave a very detailed note about NOCLAR, which is effective from 1st April 22. I'm sure members would definitely take those issues into consideration. And thank you, sir, for accepting to address our members at such a short notice and being here and addressing members this evening. Thank you, Ranjit, Kumar, Agarwal for being here. So now I take the opportunity to welcome our second speaker of the day, CA Dhananjay Gokhale. He'll be talking. He'll be addressing on the topic of overview of regulatory compliance with reference to Treasury audit and capital adequacy norms. Before I hand over the proceedings to Dhananjay, so I would like to briefly introduce him. CA Dhananjay Gokhale is a Bachelor's of Commerce from University of Mumbai and a fellow member of the Institute. He is in practice for more than 25 years. He is a founding partner of the firm, Messrs. Dhananjay J. Gokhale and Company, Chartered Accountants, specialized in providing management consultancy and auditing assurance services in corporate and banking sector. He's been a member of WSB of ICAI for the year 2018-19. He's been nominated as a subgroup member of Banking, Insurance and Pension Committee of w.r.t of ICAI for the year 2018-19. He's been a convener of study group formed for ICAI Guidance Note on Audit of Banks 2019 edition. He's a special invitee of WSB for the year 2021-22. He's a deputy convener of study group formed for ICAI Guidance Note on Bank Audit for the year 22 edition. He's a member of expert panel constituted by WSB of ICAI for addressing bank audit queries of members since 2011-12. He's also authored articles in ICAI Journal. He's been authored the ICAI Guidance Note on Bank Audit from 2016 to 2022 editions of Bank Audit. He's authored, he's one of the members, the panel of concurrent audit of banks. Reference material published by w.r.t on statutory bank audit. Bank audit material of Executive Masters Program for New Age Auditors by Central Audit Quality of ICAI. He has handled various assignments relating to the areas of bank audit, including statutory central auditors of PSBs and mergers and acquisitions of urban cooperative banks, and has been a consultant to the board of various banks. He is a regular speaker at various seminars on standards and auditing and bank audit across all regions and various branches of ICAI. He's been a speaker at staff training seminars organized by public sector, private sector, and urban cooperative banks and the Association of Banks. Friends, in fact, Dhananjay ji is presently at Madurai. He had addressed the members at Madurai this afternoon, and he is addressing us from Madurai. So I welcome Dhananjay ji to address the members.
It's visible, sir. Screen.
The screen is visible?
Yeah, visible, sir. Visible. You're visible.
Okay. Okay.
Dhananjay ji, you can start your.
Yeah. Thanks to SIRC, the entire management committee, and thanks again to Ranjit ji. I'm seeing him after a long time, so it's good to see him again. Today we'll be talking about a couple of points which are recently changed as far as the new RBI circulars are issued. And once the topic gets over, we can have a question answer session also. So I intend to first cover certain changes in IRAC norms which have been effected, followed by certain few changes in investment circular, because both these circulars have been issued after a long gap of almost 7 to 8 years since last master circular of July 15 was issued. We have another circular of transfer of loan exposures issued, and it has certain ramifications as far as the security receipts are concerned, that is SRs are concerned. So we'll just run through that also. And at the end, we will just run through certain couple of points which are of vital importance as far as capital adequacy norms, compliances, and certifications are concerned. So this is how I wanted to structure. So we'll start it one by one. To begin with, this is just a glossary of the recent circulars which RBI has issued and which one should be referring to. So there are two clarificatory circulars which have got issued subsequent to 1st October 2021 Master Circular of IRAC norms. So first circular got immediately issued on 12th November 2021. It clarified certain provisions. It tweaked certain provisions related to IRAC norms which were issued in October 21. Later on, we have another circular of 15 February 2022, which again is in the nature of clarificatory in nature. So these are two circulars which needs to be read along with October 21 circular. Then we have 25th August 2021 circular, which is a master direction issued for investment portfolio of the bank. We have 28th July 2021 master direction related to CRR SLR compliances. And we have 24th September 2021 master direction again. It is talking about transfer of loan exposures directions 2021. So to begin with, I will start with the circular which was issued on 12th November 2021, which talks about, or rather which throws light on certain important aspects. So it is divided into different paras. So we'll go para by para. Frankly speaking, the October 21 circular doesn't add anything new as far as IRAC norms are concerned. So it's more in the nature of compilation of all the circulars which have been issued after last master circular of July 15 till you can say till September 2021 end. So it's more in the compilatory in nature, but 12th November circular is changing certain things and clarifying couple of things. So the first para of 12th November circular, it talks about mandating the bank to specify the due dates and repayment dates in the sanction term itself. Now, what does this really mean? It means that whenever a bank is sanctioning any loan to any borrower, the bank should ensure that the due date of repayment of installment or due date of repayment of the entire loan has to be specified in the sanction term itself. So the bank cannot, keep a flexibility of repayment. So the exact due date has to be crystallized. The documentation should speak about the crystallization of due date. Now, what is the vital importance of this due date? As you are aware, almost all IRAC norms are related to 90 days delinquencies. So when we are counting that 90 days delinquencies, the starting point is the due date. And if just to take an example, suppose a term loan is having a due date of say 10th of every month. It means that if the installment which is due on 10th of a month, let's say 10th of February. So suppose on 10th February you don't receive the installment, it means that the account is overdue at the end of the day, that is at the end of 10th of February. So if you don't receive installment on 10th of February, the first delinquency date, that is the first overdue date, is 1st of February. 10th of February. So that's the importance of due date. So every bank has to fall in line as far as specification of due date is concerned. Second thing is that as far as classification of SMA and NPA is concerned, RBI has categorically stated that the classification of SMA and classification of NPA has to be carried out as on every end of the day. So it has to be the flagging process for every account, whether it is a SMA category or whether it is a NPA category, that has to be part and parcel of EOD process, that is the day end process. So what every bank or what every CBS which is implemented in the bank is supposed to do is, at the end of the day, when the books are getting closed, that is the point when the verification of SMA classification and NPA classification has to be triggered. And if an account is falling into any SMA category or NPA account category, as a part of end of the day process, it should flag that account accordingly. So there is nothing like a bank can identify the account on daily basis and mark those accounts on a periodic basis. That system has been completely dispensed of. So every day is kind of a cutoff date. So every day the bank has to test every account, whether it is a SMA or NPA account. So that is the second paragraph. Third paragraph is definition of out of order, which has got tweaked. Now let me tell you what has been really tweaked. So if you recall, the earlier circulars were giving 3 conditions to call a CCOD account as out of order account. So which were the 3 conditions? First condition was that if the account is continuously overdrawn for more than 90 days, then the account will be marked as NPA. So that was the first thing, and which was the simplest thing to adopt. Then second and third conditions were talking about the quarter end position. So the second condition was that if as on a quarter end, if in the last 90 days, if there is no credit in the account, then that account will be marked as NPA even if the account is not overdrawn. So the account might be within the limit, but there are no credits for last 90 days of the quarter end. So in that case, the account will get marked as NPA. And the third condition was that as on quarter end, if your interest which has got debited in that account in last 90 days is more than credit summation in equivalent period, that is in last 90 days, then the account will get marked as NPA. So that was the criteria. Now the quarter end concept has got changed, and quarter end concept will be applicable instead of every quarter end. It will be applicable as a part of end of the day process. So in a way, it's a kind of moving 90 days concept. So now let me tell you what is meant by moving 90 days concept. That word is not used in RBI circular. I'm just using that word for convenience purpose. In moving 90 days concept, let's presume that today it's say 5th of March. So on 5th of March, day end process, when we want to test this out of order status, all the three conditions will be tested as on 5th of March, end of the day. So the first condition about continuous overdrawing beyond 90 days will be 5th of March will be the 90th day, and you have to go backwards and test that whether it is continuously overdrawn or not. Similarly, as far as the condition of no credits in the account in last 90 days is concerned, instead of quarter end, we need to verify that as on today's day, end of the day. So 5th of March is your 90th day, and you have to go backwards for 90 days and verify credit in get marked as whether any credit entry account or not. If there is no credit entry, as on 5th of March, you have to go backwards. 5th of March, you take a summation of interest debited in the account. So typically it will be December interest, January interest, and February interest. Take a summation of that. If credit summation is more than interest debited, the account is standard. If it is less than interest debited, the account will be required to be marked as NPA. Now, as far as this 90 days, moving 90 days concept is concerned, the 15 February circular also clarified that the day, that is the day end process, when this day end process is conducted, that day is presumed to be 90th day. So you have to go backwards based on that, and that has been already clarified. Then the fourth para talks about removal of dispensation or removal of concession which was given in RBI's IRAC circular. The concession was in the form of para 2.1.3. As per para 2.1.3, there was a concession given to term loan accounts wherein only interest was due. So let me just give you an example. In normal term loan, what we consider is there might be multiple ways of repayment of term loan. One way is that there might be a EMI repayment based module. Second might be that interest as and when plus fixed amount of principal repayment module. Now, in addition to that, there might be a third concept wherein in the initial period of term loan, there is no principal repayment which has been prescribed in the account. So in such cases, in the initial period, there will be only interest which is charged to the account and which is supposed to be paid by that particular borrower. So in such cases, there was a concession which was given. What was the concession? This para 2.1.3 specified that whenever in a case of a term loan account, only interest is due and payable, then interest debited in the account in a particular quarter, if it is not paid in next quarter, then the account will be marked as NPA. Just to give an example, presuming that this condition still exists, then for March 22 audit, what you need to verify is the interest which is debited in the account from 1st of October till 31st December 2021. If it is not paid by the borrower in next quarter, that is by March end, then only the account will get marked as NPA. So this concession has got removed now. Now, because of removal of this concession, what will happen is whenever interest is charged to the account and whenever the interest is due, to be specific, then that particular interest has to be paid by the borrower before 90 days from the date on which the interest is debited in the account. So the due date concept wherein the dispensation was given in para 2.1.3 is no more there, and everywhere now 90 days concept will be the standard now. Then in case of upgradation of the accounts which are classified, fifth para is only a clarificatory kind of a para. It talks about upgradation of account, and it specifically clarifies about partial recoveries and subsequent recoveries. What it says is, now before I explain about the concept of this upgradation of account, let me talk a little about the earlier circular which RBI has issued. RBI has already issued a circular wherein it has already asked all bank that the entire process of income recognition and asset classification is required to be an automated process. So what it indicates is, it means that downgrading of an account as well as upgrading of the account along with income recognition and provisioning norms has to be an automated process. There should not be any manual intervention in that. Now, in the background of that, when RBI is categorically now again reiterating the point that whenever you want to upgrade an NP account, you need to upgrade that when entire arrears of interest and principal are paid by the borrower. It means that the account should be in such a status that there is completely no overdue status. So unless no overdue status is achieved at a particular end of the day, the account cannot be upgraded. Now, what it indirectly means, or what it indirectly reconfirms is, it means that firstly, partial recoveries will be redundant. So suppose you have a term loan wherein 4 installments are overdue, and the borrower has paid partially that overdue installments to the extent of say 2 installments. So now number of installments overdue are only 2, but this doesn't stipulate that the account should be upgraded. So this was what was expected even in earlier norms, but RBI just reiterated that. There is one more interesting thing which has happened, because of automation of NPA process. Earlier, there used to be a lot of arguments which used to go between auditors as well as auditee. That is, auditors as all of us and auditee as bankers. That many times the bankers were saying that whenever there is any subsequent recoveries made in the account, or whenever the NPA account is subsequently closed before you sign off your balance sheet, you consider the account as performing as on the balance sheet date, that is as on 31st March. So let's take a case that as on 31st March, you have 4 installments overdue, and you're signing off the balance sheet as a central auditor on say 5th of May. So whenever there will be a recovery, in between 1st of April till you sign off your balance sheet, so 6th of May. You used to that you can and say standard. My personal views even earlier was the same, that whatever is the position as on 31st March, the auditor has to stick to that. Whatever happens after 31st March, that will be taken care by in financial year. Now, because of automation, the stand or use reiterated system express, it gets, if you are having a system where your bank CBS system claims that there is automation of IRAC norms, so it indicates that. So once your data norm your IRAC process is also concluded for that particular date. So under no circumstances you can have a scenario will go backdate. So about for loans and wherever there is a moratorium period of interest is given. Now, as far as recognition of interest is concerned, what RBI has categorically stated is the recognition of interest when moratorium of repayment of interest is granted, that is possible. Now, what is the reason? Now, let me tell you the reason for that and what is the underlying. Let me just correlate that with FIDL. The recognition of interest which factor for repayment of of interest.
Sir, your audio. Dhananjay sir, are we audible to you? Hello.
Yeah, am I audible? I think in between there was a connection loss.
Yes, sir. Yes, sir. There was a disturbance for past 10. Yes, you're audible now, sir. But the thing is that for last 1 minute or so, there was a lot of interruption actually. So it was not fully conveyed. Maybe if the network is a little bit on lower side, you can turn off your video and then we'll continue. So sort of, you can turn off the video and just check the internet is up upon better speed or something, because it's your voice is still getting disrupted. That is, it is getting on and off. No, so you're not audible now. Maybe
audible now.
No, sir, not yet. You're audible, but your voice is getting frequently interrupted. 1 minute, sir. We'll just check.
Okay, it's still not proper. Switch on to other mobile.
Yeah, now it's.
Just give me a minute. Just give me a minute.
Now it's proper, sir. Now it's proper. You just go for another 10 or 20 seconds. We'll see whether it's going fine or
not. Okay, no problem. Fine. Otherwise, I will switch on to other mobile. So if there is any interruption, just let me know.
Yeah, maybe you can. We'll see for next 30 seconds. If not working, we'll check for next mobiles. Hello.
Okay. Let me know if I'm not audible. I will just repeat what I said earlier.
Last 1 minute or so, please.
Now, yeah. So I'll just go a little backwards, and I will reiterate. So what I was talking about is that as far as upgradation is concerned, one has to ensure that the entire arrears of interest and principal is paid by the borrower. It means that at the end of the day, there has to be a position wherein there is absolutely no overdue, which is the account is not eligible for upgradation. Upgrading an account on the basis is the first point. So recovery. No question of partial. That is a second point is that as subsequent NPA on 31st March, concerned and has is instantly the bank in that account. Let's say on 15th of April, entire overdue portion is recovered. Then in that account, as on say 31st March, something which is expected to be prohibited. Now, what I was correlating this subsequent recovery was with respect to the automation circular. RBI has stipulated that the bank should ensure that the CBS is capable of completely automating the IRAC compliances. Now, what it means? It means not only to identify that account as NPA as a part of end of the day process, it also means in that case that the upgradation of the so in that case, practically, bank cannot even claim subsequent recovery should be factored in prior to 31st March, wherever recoveries are subsequently. The reason being, you cannot have any manual intervention which can be made in CBS system as far as upgradation is also concerned. So subsequent recoveries are redundant. One should not have to pay any attention or any importance to that. Then the 6th paragraph is about the income recognition policy for loans with moratorium on payment of interest. Now, as far as moratorium on payment of interest is concerned, there are two factors which I will like to offer over here. First thing is that what RBI has clarified is whenever there is a moratorium granted for repayment of interest, then in that case, since the interest is will be treated as, so you can recognize the income in the form of such interest wherein moratorium is granted due. Now, second thing, what it really indicates is this is not the case.
Sir, sorry to interrupt. It's again going off with this fluctuation. Hello.
It's not.
Sir, hello.
See, what is it? expect that it is. Yeah, I'm just doing that. Am I audible now?
Yes, you're audible now, sir.
Okay, now it's clear.
Yeah, it seems to be clear. There is no fluctuation as of now. We'll see.
Just okay. Yeah, and the slides are visible now.
Yeah, yes, slides are visible, sir. It's in 5th slide, IRAC circular.
Yeah, that's right. That's right. Okay. So I will just reiterate from the 6th point which we are talking about. So as far as income recognition part is concerned, RBI has clarified one point, that wherever a bank is having a moratorium period granted for repayment of interest, the bank can very well recognize that portion of interest as its income, in spite of maybe non-repayment of interest. The reason being, whenever a bank is sanctioning a moratorium period for interest portion, it stipulates that the interest is not due immediately when the account is getting debited. So it is kind of accrued but not due concept. So bank can very well recognize the income in spite of not being in receipt of that particular interest. Now this is just a clarification which RBI has given. It has nothing to do with FITL concept. The reason being, how how to distinguish between these 2 points. Here, what is expected from RBI's angle is that these are the typical scenarios wherein the bank has sanctioned a particular borrower, that there is a moratorium period of certain period which is given to him for payment of interest. So let's take an example, that as a bank I have sanctioned a limit of 100 crores to a borrower, and I am disbursing only 95 crores, and 5 crores is the cushion which I am keeping for repayment of interest. So it's a kind of a moratorium which I am giving. So I am already factoring in that moratorium period as far as the repayment part is concerned. So in such cases, I don't have to really say that the income should not be recognized at that point of time. It is already factored in my sanction terms. Second example is that there might be a case wherein moratorium period is granted as a part of sanction for say for 6 months. So the interest which is debited in the account is due only after 6 months period. So in that case, the same logic prevails. So the interest which is debited in the account for 6 months period will become due only at the end of the moratorium period. So interest can still be recognized as income. Now, how it differs from FITL? Typically, in FITL cases, the interest is already debited in the account, and then the interest gets carved out of that account, and a separate facility with the nomenclature of FITL is created. So in such cases, you need to ensure that 100% provision is made, because a bank cannot say that the income is received by way of creation of a new facility. So in such cases, you need to maintain an equilibrium by creating an equivalent provision on the liability side. So indirectly, you need to derecognize the income whenever FITL is sanctioned. Okay. Then couple of points related to 1st October 2021 circular. I just thought that I will just quickly have a cursory glance about that. Para 4.2.2 talks about warranting the banks to ensure that there is an appropriate internal system for proper and timely identification of NPA, which has to be created by the bank. Now, the reference for this para is, there was a circular issued on 14th September 2020, wherein RBI had mandated the automation of IRAC as well as provisioning process. So what RBI is expecting from the bank is there should not be any manual intervention as far as IRAC compliances are concerned. So that is the first thing. There is para 4.2.19.3, which has tweaked credit card related part to a little extent. It says that credit card charges such as penal interest or reporting to CIC, that is credit information companies, will be done only if the credit card account is remaining past due for more than 3 days. So suppose you have a credit card which is having a due date of say 2nd. So the levying of penal charges as well as reporting to CICs will happen only if the credit card dues are not paid by 5th. So 3 days grace kind of a period has been granted as far as credit card charges are concerned. Then para 5.6.2.3 talks about utilization of floating provisions which are held as on 31st December 2020, wherein the utilization of floating provision can be done to the extent of 31st March 2022. So if a bank is holding a floating provision as on December 20, the entire floating provision can be used for creation of the required BDDR for the current financial year, that is financial 21-22. Para 6.2.2 is a kind of a little interesting kind of a paragraph. The para talks about the prudential write-offs or technical write-offs. Typically, the banks used to write off accounts, or I should say prudentially write off account or technically write off the accounts under the pretext that there is an income tax concession which is available for that. In the sense, they can claim this as a allowable expense in income tax. Now, RBI has categorically specified under this para that the bank can do this technical write-off only if all the available means of recovery are extinguished before writing off of any account, whether it is fully written off or partially written off. And secondly, the bank has to disclose the quantum of accounts which are written off, that is technically written off. Now here we are talking about only technical write-offs and not actual write-offs in terms of OTS or any other scheme wherein it is permanently written off. So the banking you can say practice of technical write-off of the account and cleaning of the balance sheet and claiming the income tax rebates on that will be subject to this provision that the bank should ensure that they are extinguishing all the available means of recovery before these technical write-offs are undertaken. Para 7 talks about NPA management and it talks about requirement of effective mechanism and granular data. Now, what it really hints at it, as far as the CBS softwares are concerned, the CBS software should be capable of firstly accepting the master data in entirety, in the sense whatever is required to automate the CBS system as far as the NPA norms are concerned, that is required to be capturable by the CBS system. And secondly, the granular data related to any account should be available at any point of time, and based on that, the effective mechanism should be built in by the bank to generate the required MIS report, and also to ensure that the RBI circulars are also implemented in the CBS system. Then para 21.6 talks about unrealized income represented by FITL. So as we discussed earlier, wherever FITL is created, one needs to ensure that there is a corresponding provision which is created by way of debit to P&L account and credit to sundry liabilities account into bracket interest capitalization. So the concept of FITL still continues. Para 30 talks about bank loans for financing promoters' contribution, and here, as far as the restrictive part is concerned, RBI has clarified that the banks can finance the promoter's contribution only in such instances wherein the finance is given to specialized entities which are formed for either taking over or turning around the troubled entities. Otherwise, financing for promoter's contribution is categorically prohibited by RBI. So it's only on a specific case-to-case basis wherein it is permitted that the bankers can extend the promoter's contribution. Otherwise, it is not supposed to be the case. Now, before we go to the investment treasury related norms, I will just like to just run through certain aspects which 15 February circular has been talking about. So few things we already covered. That is the previous 90 days period we start from the end of the day. So suppose today you are carrying out the end of the day process, or say checking an account for out of order status, then in that case today's day will be considered as 90th day. And another thing is that as far as the NBFCs are concerned, even though this is not the topic of today's discussion, but NBFCs have been asked to ensure that they have a time period which is given till 30th September 2022, wherein they need to ensure that an NPA account will be upgraded to standard asset category only if entire arrears of interest and principal are paid by the borrower. Only one odd point over here is that at least I have not come across any RBI circular which has ever positively stated that partial recoveries are permitted for upgradation of the account in NBFCs. But nevertheless, now this 15 February circular has made this point clear that the same norms will apply to NBFCs also by September 22. So in 6 months to come, 6 to 7 months to come, even NBFCs will be at par with the banks. Now let's come to the master directions on investments, which are issued on 25th August 2021. Frankly speaking, not much has been changed in that. So I've just picked up certain important paras in that particular master direction. So the first para is para 8, which talks about shifting of securities to and from HTM. As all of you are aware, shifting of securities from HTM to AFS or HFT or vice versa is permitted only once in a year, and that too at the beginning of the year. So wherever you are doing treasury audit, just inquire that which securities are shifted during the financial year and what is the timing of that shifting. So one has to ensure that it is once in a year, and subsequently it is never allowed. Now, what is meant by beginning of the year? Beginning of the year ideally should be April or at the most May. First half year, first quarter, that is something which is not a logical thing to do. So verify that what is the date of shifting from HTM category to others and vice versa. Para 9 talks about impairment of HTM security. So there are certain conditions which RBI stipulated as to when HTM security, that is HTM classified security, has to be called as impaired. So if any of the conditions of impairment is fulfilled, then RBI has stipulated that the provision is required to be made for each investment. So just to give an example, suppose we are having say 100 scripts in HTM category. Out of that, say 3 HTM securities are impaired. So in those 3 securities individually, we have to do mark-to-market exercise, and then you have to provide for those HTM securities on an individual basis. So no netting off or grossing off is supposed to be done. As far as provision under AFS and HFT category is concerned, which are made for investment, which are also called as investment depreciation reserve, it is required to be made on the basis of aggregation of net appreciation and depreciation within the category. And when you do that, you have to combine both domestic as well as foreign securities. Just to give an example, suppose in case of non-SLR securities, you are calculating the IDR, and while calculating IDR, as you are aware, that you have to aggregate based on balance sheet classification categories. So suppose you are aggregating non-SLR category. Under non-SLR category, even if you are holding domestic and foreign securities, both should be combined together, because within AFS and HFT, there is no further bifurcation between domestic and foreign security which needs to be made. So you can have a scenario wherein domestic, let's say domestic corporate bonds have appreciated and foreign corporate bonds have depreciated. So netting off is very much permissible. Para 9 also talks about the security receipts and pass-through certificates, that is PTCs. Now, as far as this accounting of SRs is concerned, let me give a little background about that, because the same thing we will be discussing in subsequent slides also. A typical case of creation of security receipt, or the bank getting security receipt, is bank might be having a NPA portfolio, which as a part of cleaning of process, the bank might sell it off to ARCs. Now there are 2 ways to sell this portfolio. One way to sell this portfolio is that the bank can sell this for on all cash basis. It means that the entire portfolio will be sold off to the to the ARC or maybe to other financial institution without recourse. So they pay you a lump sum amount, and after that, whatever plus minus the amount is realized from the NPA, such NPAs, the taking over entity will be taking risk and rewards related to that. So the bankers will simply get a cash amount, and the matter gets over there and there itself. There is another way out, is that the NPAs are sold off to say ARCs, and against those NPAs sold off to ARCs, there will be naturally a special purpose vehicle which will be created, and in special purpose vehicle, the NPA accounts or the bunch of NPA accounts will be taken over, and against that, security receipts will be issued. Now, when the security receipts are issued by the special purpose vehicle, there is always a contribution from bank as well as by the ARC which will be made. So to the extent of contribution of bank, the security receipts will be received by the bank. So what will happen is the NPA accounts which are sold off to ARCs, they will exit out of the books of accounts of the bank, and what will be inverted is the security receipts which will form part of security portfolio, that is treasury portfolio. Now how it happens, let me just give you an example of that. Let's presume that I'm having a bunch of NPAs which is sold off, and let's say the ledger balance is 100 rupees, and I'm having a BDDR provision held against specifically for those NPA accounts to the tune of say 50 rupees. And against that, let's take a example that I'm getting a SR worth rupees, say 40 rupees of face value. I'm not getting into ratio of how much is ARC is subscribing and how much is bank is subscribing. Let's talk about plain and vanilla accounting. So what is going out is my net book value. So net book value is ledger balance minus BDDR which is held specifically for that NPAs. So my net book value is 50 rupees. Against that, I am receiving the security receipt which is having a face value which can be called as redemption value also, to the tune of 40 rupees. So the initial recognition will be lower of redemption value or net book value. So I will account for the security receipts in my books of account at 40 rupees. And the differential 10 rupees will go to my P&L account. Let's take another scenario. Let's presume that instead of 50 rupees of net book value, I am getting a security receipt of 60 rupees. So in that case, what will happen is the initial recognition will be lower of redemption value of or net book value. So I will account for at net book value of 50 rupees only, and the gain, that is 10 rupees gain, will not be recognized at the initial stage. It can get recognized only to the extent of SRs which are subscribed by that ARC. So suppose ARC has taken a stake of 15%, and you have a scenario wherein against 50 rupees of net book value, you have a redemption value of 60 rupees. So 15% of that 10 rupees, that is 1.5, will get recognized as income in your P&L account. So it will be confined only to the extent of realized portion and not the entire gain. And subsequent to acquisition of SRs, one has to do a periodic valuation, which is parallel to any non-SLR security valuation. And for SRs, the ARCs will declare the NAVs, and NAV will be presumed to be the market value. So you need to keep on comparing your book value with NAV. If there is any shortfall, you have to create IDR. And this IDR is created is for non-SLR securities, because SR is a non-SLR security. So it gets aggregated, and whatever is the net position of IDR, that will get accounted for. Para 11 talks about short sale of securities. No change in short sale of securities guideline. The guidelines remain same. Para 14 talks about internal control system which has to be existent in the bank. A simple example of that internal control system can be the serial numbering of the deal slips, which as an auditor you can verify that the serial numbering of the deal slips is in the same order of the time at which the deals are struck. So you can just correlate the deal tickets and deal slip serial numbers, and there should not be any scenario wherein the time chronological order of time is not adhered to while creating the deal slip. Then one more thing which we need to ensure is that we need to verify that whether the bank is periodically reconciling the investment portfolio or not. So that is mandated for the banks, not for the auditors per se. And the most important factor is that as a central auditor, you need to issue a certificate of compliance in key areas. And usually I have seen that most of the auditors are issuing a kind of a negative assurance by using the wordings like nothing has come to our notice that any of the key areas of this Treasury Master Directions are not complied by the bank. But whenever you are issuing this compliance certificate in key areas, always make it a point that go through the master directions once again, verify that whether each and every para is whichever para is applicable to the bank which you are doing the audit, and whether it is complied by the bank or not. Unless and until you are really satisfied, such certificate shouldn't be really issued. Then para 19 talks about the non-performing investments. The non-performing investment norms are same. In fact, almost same logic of IRAC norms is carried out over there. Very important factor which one needs to keep in mind is that whenever you are creating a provision for NPI, that NPA provision cannot be set off against the performing investments wherein the appreciation has occurred. So the netting off portion is confined only to the extent of mark-to-market position. It has nothing to do with non-performing investment provision. Both are different. So IDR is different and provision on non-performing investment is different. And you have to make 100% provision on non-performing investments. So this was all about treasury part. Let me talk a little about CRR SLR. As far as master directions of CRR SLR are concerned, everything has remained same except for couple of points. So one point is related to the calculation of a saving account bifurcation between demand and time liability. And there is one more thing which has come up about NDTL calculation. So first, let me talk about this portion. As compared to earlier norms, the norms for bifurcation between demand and time liability portion of saving account GL balances is changed. So it stipulates the steps also to calculate that. So first step, as a matter of first step, what one needs to do or what the bank is supposed to do is that for every saving account, they need to calculate a monthly minimum balance. So let's take an example that we are talking about the first half month of the current financial year, that is 1st April 2021 till say 30th September 2021. So for this entire 6 months period, for all 6 months, for every bank, for every saving account, bank has to calculate minimum monthly balance. That is a minimum balance in that month. And then it has to take an average of that 6 months. And then it has to sum up at GL level. So for every saving account, we will get 6 figures of minimum monthly balances. Then you need to average that for 6 months. And then you have to add up all the saving accounts together. That amount will be your time liability. Then as a second step, at GL level of saving account, you need to calculate the average balance for 6 months. So from 1st of April to 30th September, calculate average balance. And from that average balance, reduce the time liability. So the time liability which you have calculated by the first example, you need to reduce that from average 6 monthly balances, and what remains is your demand liability. So these two figures of time liability and demand liability, that is the ratio which you need to use for next 6 months. So the ratio which you calculate for April to September based on database of April to September, you need to use for October to March. It's only a bifurcation requirement for reporting purpose, but since as an auditor you will be checking the NDTL forms as a part of your CRR/SLR verification process, this is something which you need to see whether the banks have factored into that reporting requirements. Second change which has occurred is in NDTL calculation, RBI has categorically stated that provision for income tax should be excluded. Now this is little tricky, and as I understand informally from a couple of inspectors who do AFI inspection and a couple of banks also, there was a kind of a odd and stringent stand which a few RBI inspectors or few auditors might be have taken, that they used to take the income tax provision at gross level. And there was always a hue and cry against that. The reason being, when you are having an income tax provision on liability side on the gross level, on the asset side, there is almost an equivalent amount of asset which is lying over there. So practically the surplus of provision or the additional provision which is really required or which can be quantified as a liability for the bank will be only to the tune of provision minus my asset, which is in the form of income tax paid. But maybe since RBI is satisfied that there is hardly any difference between these two, they have said that income tax provision should be ignored. My personal view is a little different. What I feel is, instead of simply ignoring income tax provision, that might amount to a scenario wherein the bank has created a provision, but the taxes are not paid by the bank. Maybe that the bank has paid the taxes only in the month of September, related to the earlier financial year. So in that scenario, what will happen is, for all my fortnights from April till I pay the taxes in say September, my liability will be getting understated. So the best way is that whenever the income tax provision is made, better to correlate that with taxes paid and take a net figure and consider that as a liability as a conservative principle. But that is a change which has occurred in NDTL calculation methodology from RBI side. Let me touch upon now master directions on transfer of loan exposures which are dated 24th September. A couple of definitions which have been given. And before we touch upon the definitions, one important factor is that in the introductory para itself, RBI has clarified that the directions will be coming to an effect with an immediate effect, and it will replace all earlier existing instructions. So from 24th September, whatever is stipulated in this master direction will prevail, and earlier concessions or whatever instructions RBI has given, that will be redundant. So always keep this point in mind. Net book value is defined over there. Net book value is funded outstanding exposure, loan exposure, which will be reduced by specific provision which is made against such exposure. So that is a NBV is defined. Chapter 4 talks about transfer of stressed asset and transfer of loans. Within that, the para C talks about transfer of loans to ARCs. I've just picked up a couple of ticklish paragraphs over there. So first thing is that which kind of loans can be transferred. So para 73 says that stress loans which are in default for more than 60 days can be transferred, and stress loans are those loan exposures that are classified as NPA or SMA. So that is the definition of stress loan. So RBI has stipulated that which kind of loans can be transferred. Para 75, it talks about whenever a stress loan is transferred to ARC at a price which is below NBV, that is below net book value, then in that case banks can use counter-cyclical or floating provisions. So that is a kind of a relief which is given wherever you are landing up in a scenario wherein the price which is paid by ARC is below NBV. Then para 76, it talks about a scenario wherein if a stress loan is transferred to ARC at a price which is above NBV, that is, it is more than net book value, then in that case, the excess provision can be reversed to profit and loss account only to the extent of cash received as an initial consideration. So the example which we are talking about, NBV being 50 rupees and price which is paid by ARC is say 60, that is the SR is 60, but 15% is the only stake which is taken by ARC. So to the extent of cash received is only 15% of 10 rupees gain. So only to that extent I can reverse the excess provision to P&L account. Para 77 talks about mark-to-market periodical mark-to-market requirement, wherein the NAV will be compared with the book value and required IDR will be created. Proviso to para 77 gives two highlights actually, or two conditions. First thing is that the accounting has to be lower of net book value or NAV. That is the first thing. As far as the second proviso is concerned, it is a very interesting proviso. So let me first read out the proviso and then let me just interpret it. It says that when the investment by a transferor in SR, transferor means banks. So when the investment by bank in SR is backed by stress loans transferred by it, and if such investment by that bank is more than 10% of all SRs backed by its transferred loans and issued under securitization, then the valuation of such SRs by transferor will be additionally subjected to a floor of face value of the SRs, which will be reduced by provisioning rate as applicable to the underlying loans had the loans being continued in the books of the transferor. So what it indicates is, let's take a scenario that as a bank, the investment, SR is received by way of sale of NPA accounts. When I'm getting a SR, then I need to consider that every SR I need to compare with my total SRs. So if one SR is more than 10% of all SRs, then in that case, there is additional provision which will be required to be made. That additional provision is equivalent to the provision which I would have made if the underlying loans were continued in my books of accounts. So in most of the cases, such loans, underlying loans, might be falling into D2 or D3 category, or eventually into D3 category. So there will be additional provision beyond NAV based provision which the bankers will be required to make, provided that such loans are more than 10% of all SRs which have been standing in my books of account. And now here, let me just clarify a couple of possible scenarios. One of the scenario might be that in certain cases it might happen that some portion of SR is recovered. So in that case, when I'm calculating my total SR for the 10% calculation, as on any cutoff date, I need to compare book value of one SR with total book value outstanding in my books of accounts. So the face value will not be really relevant. What will be relevant is exposure to SR. So that is my book value. So based on book value, I will always consider the 10% norm and then apply this additional parameter for provisioning. Then paragraph 78 talks about requirement of treating a SR as a loss asset at the end of resolution period, which can be 5 years or 8 years, depending upon the tenure of SR which the bank has subscribed to. Para 79 talks about valuation classification norms, and it has clarified that the valuation classification and all norms which are applicable to non-SLR instrument will be applicable to SRs and PTCs, that is pass-through certificates. So these are the major paragraphs which are of vital importance and directly impacting the financials of any bank. Let me come to the point of certain important aspects of capital adequacy norms, and we'll touch upon certain points. See, as far as central auditors are concerned, all of you must be taking care of capital adequacy verification at the central office level or at the head office level. But as far as capital adequacy norms are concerned, there is a certain data, especially risk-weighted assets, that is RWAs. The risk-weighted asset calculation will be at the branch level as far as the advances exposures are concerned. So you need to factor in a clear-cut bifurcation between verification of capital adequacy norms as to what will take place at branch level and what will be taking place at head office level. That is the first thing and first and foremost thing which you need to consider. Second thing is that most of the banks are now using various softwares for capital adequacy calculations, and many times these softwares are not really part of CBS system. So there are certain clinical impurities which are very much there in these softwares, and these softwares may not be really capable of handling capable of gelling with the nitty-gritties of CBS. So as a central auditor, you are supposed to test the software which is used by the bank for capital adequacy calculation by deriving a sufficient sample size data, factoring all kind of scenarios, possible scenarios which can exist in the bank, and then only the software can be really relied upon. Another thing is that there will be multiple MOCs which you might be receiving from the branch auditor, which will include reversal of income, changing of ledger account balances because of maybe revenue revenue leakages or excess interest which is charged, which might be reversed. All these will ultimately affect the capital adequacy because your ledger balances are undergoing a change, especially in case of term loan accounts. Now, in all such scenarios, you need to ensure that how the capital adequacy calculations are effected after passing of MOC. So suppose the account is marked as NPA by a branch auditor. Naturally, the capital adequacy calculation has to be changed to that effect. So this parameterization of this capital adequacy software which is used needs to be verified that whether the MOC's effects are also absorbed in capital adequacy calculation or not. Another thing is that you need to test the effectiveness of UCIC, that is Unique Customer Identification Code, and based on that, how the exposures are calculated. As you are aware that UCIC plays a vital role in capital adequacy calculation, wherein an exposure can be reduced on the basis of liability to the same counterparty. Just to give an example, suppose I'm having a housing loan in a bank and I'm also holding a saving account balance with that bank. My net exposure to bank will be housing loan minus by saving account outstanding balance. So that is something which I need to factor in. So you need to test that whether UCIC is effectively implemented and whether the UCIC is used for capital adequacy calculation or not, because that netting of concept has to be factored in whenever the capital adequacy softwares are used. Besides these few additional aspects which are important from the statutory auditor's point of view, so let me start with one of the ticklish issue as far as the accounting related to non-banking assets is concerned. Various banks have adopted various aggressive as well as conservative practices. What is the correct practice is, whenever a non-banking asset is acquired by the bank, in that case, the accounting has to be at the lower value or lower of the acquired asset value and the ledger, that is the ledger balance which is there in a particular account. So just to give an example, let's take an example that you have an account wherein say 100 rupees is ledger balance and say 90 rupees is your BDDR. So your net book value is only 10 rupees. The bank has acquired a non-banking asset which was offered as a security by that particular borrower, and let's presume for a hypothetical case that the amount is also equivalent to 100 rupees. So your entire dues are recovered. There is nothing to write off, so no question of write off. Let's not mix that topic with over here. So when I'm acquiring 100 rupees of 100 rupees worth non-banking asset, the accounting cannot happen at 100 rupees. The reason being, I'm just acquiring the non-banking asset against my ledger balance of 100 rupees, against which BDDR of 90 rupees is there. So practically, I'm having a net book value of only 10 rupees. So I need to continue that net book value, presuming that it is lower than the value of non-banking asset. And as and when the non-banking asset will get realized, that will be the point wherein the income will get recognized between 10 rupees of net book value and the realized portion. So till the time non-banking asset is not realized, bank is not supposed to recognize the income as a conservative principle. Second thing is that on a year-on-year basis, bank needs to test that whether the value of non-banking asset, which is reflected in the books of accounts of the bank, whether it is correct or not, in the sense whether the realizability test is passed by that non-banking asset or not. So ideally, bank should take a valuation certificate, and it should go by the realizable value and not by the fair value, which might be on a higher side. Second point is that as an auditor, you need to factor in that whether the Banking BR Act, that is the Banking Regulation Act, and Companies Act, in case if you are doing a private sector bank, is complied or not. Whenever you are compiling your statutory audit report under SA 700, you need to ensure that the provisions of BR Act as well as the applicable act, like as I said, possibly Companies Act, is complied or not. All of your central auditors, so I don't have to really harp on compliance of standards on auditing. I'm sure that you must be already taking care of. Pay adequate attention to SA 600, wherein communication with the branch auditor is something which one has to factor in before before the branch auditors really commence their work. Also factoring the part of IFCOR, which you want to rely upon based on the testing which is required to be done by the branch auditors. So there has to be a clear-cut communication with the branch auditor, which needs to be taken care of. Another thing is that as far as the various MIS reports are used by you while performing the duty as statutory auditor, just check that whether the MIS reports are functionally correct or not. So do a functional testing of vital MIS reports which you intend to use for your audit process, rather than relying blindly on the CBS system and presuming that each and every report generated from CBS is true and correct. Don't rely blindly on that. Do a testing at your end also. Another thing is that you need to also factor in that which are the exceptional reports which are readily available, and which are the exceptional reports which you want as a kind of a customized, from customization point of view. So give the bank your requirement of customized exceptional report very in advance. Factor in that what you require as a part of customization. Define your conditions and define that which condition-based customized reports are expected from the bank for your exercise, for your audit exercise. Another important factor is that many times the banks are having multiple softwares which are in use. One of them we already discussed, like the capital adequacy norm related part. So first, obtain the list of various software which the bank is using, and then verify that how the bank is ensuring that all these softwares are integrated with each other or not. And most important factor is that verify that whether these softwares are really capable of adopting the RBI regulations which are issued from time to time. Let me just give one example. As far as IRAC norms are concerned, as we discussed, there were two circulars which got issued in November and February, wherein certain norms were tweaked, certain norms were reconfirmed. Inquire with the bank as to how the this tweaking or change in IRAC norm has been adopted by the CBS, and what is the effective date from which such changes have been effected in CBS. So ask the question to the bank, and on similar lines, whenever there is any change which RBI has factored in, inquire with the bank as to how the CBS is factoring in the changed RBI regulatory norms. Automation of IRAC norms, I have certain reservations about that, even though the banks are claiming that the IRAC is completely automated. Let me just spell out one of my reservations. When a bank says that entire CBS is compliant with IRAC norms and everything is automated as far as asset classification and income recognition is concerned, I just have two points over here. One example is that does this include the agricultural advances also? And if yes, how the data for agricultural advances is captured by the CBS system? That is point number one. Second is that as far as income recognition is concerned, as all of you are aware, as far as interest charging in agricultural advances is concerned, it has to be charged on the basis of crop pattern. So compounding of interest is not possible. Compounding is possible only on the basis of crop cycles. So suppose one is having a crop cycle of say 10 months, then 10 months interest will be charged and compounded only after that. So monthly compounding is not possible. So just test the software as to whether the CBS is really adopting everything in what is written in IRAC norms or not, and draw your inferences and conclusions from that. Another just a piece of advice, even though many of you might be doing that, is create awareness about the CBS, the typical commands in CBS, which your staff who is actually doing the audit is well aware about. Try to start using CAD tools which are available. There are certain companies which are having a kind of a tie-up arrangement with CNCU. You can check up that also to get it at the concessional rate if it appeals you. But otherwise, try to start using CAD tools. I have seen most of the firms completely relying on the Excel and using Excel worksheet for deriving various exceptional report. I'm not for or against Excel. Only thing is that whenever you are doing any data crunching in Excel, there is absolutely no possibility of creating audit documentation for that. Typically, most of the CAD tools which are available, they create an audit trail for whatever process you have carried out on the data which is provided to you by the bank. So it gives you a kind of a handy tool wherein you can prove before anyone, maybe it can be a peer reviewer or it can be RBI as a regulator, that what kind of data crunching you have done, what kind of logics which you have tested. So it becomes a kind of a easy to use and easy to store kind of a process driven audit. MRL, I'm sure all of you are well aware about. Since all of you are central auditors, I will suggest you that to push the MRL to the branch level also, to ensure that the branch level also receives a MRL. Maybe you can think of having a standardized MRL prepared by you, which becomes a part of the closing instructions, wherein the standardized MRL at least gets issued at the branch level. So the branch auditor doesn't have to really run after after the bank for getting a MRL. So that was all in nutshell. I didn't get into details because I thought that we can have an interaction and we can have question answer also. So if any questions are there, we can take up all the questions one by one.
Yes, sir. I'll just share my screen. Some question that came up earlier.
Sure. Sure.
Is my screen visible?
Yeah, your screen is visible. Okay, just
So these some question came up at the initial stages.
I will try to answer as much as possible. The first one is whether a CA firm conducted ICAI also conduct statutory audit of the bank. As you're aware, RBI stipulates that 1 year prior to your appointment as statutory auditor and 1 year after the appointment of your firm as a statutory auditor, you are not supposed to undertake any of the assignment. That any assignment includes everything. It can be ISA, that is Information Security Audit. It can be a stock audit. It can be a concurrent audit. It can be anything. So there has to be a complete cooling period of 1 year prior to your statutory audit and after you conducted the statutory audit. So that is something which is prohibited now. Concurrent auditors of a bank branch cannot review and certify quarterly asset classification statement as per ICAI Council's directives. But many banks are asking CAs acting as concurrent auditors and all are certifying. Should the ICAI not take up this matter with banks management? I will just give a different kind of perspective. See, as far as concurrent auditors are concerned, the asset classification, or rather, I should say, review of asset classification can very well be carried out by concurrent auditors. Till the time you are not stepping into the shoes of statutory auditors, concurrent auditor can very well verify that. So instead of certify, I will say that you can always verify and review the asset classification statement which is prepared by the bank. You don't have to really certify that. And you can use the guidance note on special reports which is published by Institute in 2016 and make use of that. Many banks are not cooperating in acknowledging letter of engagement and letter of representation. Bank central office clearly stated in their instruction that such document would be given only to SCAs and not at the branch level. ICAI should take up with the bank management and convince them that these documents are equally applicable to the branch auditor. See, what I will suggest is, in fact, this used to be the issue earlier, but now in most of the banks, this issue had got resolved. I have seen most of the banks started issuing acknowledging the letter of engagement as well as issuing letter of representation to the branch auditors also. If not, take up the matter with your central auditor of your region, and through central auditor you can definitely ensure that you get the acknowledgement of letter of engagement and you get a representation letter from bank management. I will also suggest you a couple of other things. So as far as acknowledgement of letter of engagement is concerned, that is something which is very much possible. They hesitate in acknowledging any written document which you give. The challenge in letter of representation can also be tackled in a indirect way. You issue a kind of a negative confirmatory letter, take acknowledgement of branch manager and keep it as a part of your documentation process, which will resolve that MR related portion to a certain extent. But the best way is that take up the matter with your central auditor, and ideally the central auditor will resolve such instances. Fourth one is, what is the reasonable time for previous auditor to respond to NOC sought by a new auditor, particularly in case of bank branch audits where the time given to complete the audit is hardly 10 to 12 days. As far as NOC issuance is concerned, it's something to do with within the CA fraternity. So my personal view is that the previous auditor has to immediately respond to the NOC and maybe send an email also, which is more than sufficient compliance with obtaining of NOC. And anyway, nowadays almost all of us have started using the digital signatures. So practically the physical movement of letter seeking NOC and getting NOC against that is also possible through electronic media. Can a member accept a bank audit assignment when he has availed a loan on own fixed deposit with another branch of the same bank? See, as far as this question is concerned, firstly, you need to refer to Code of Ethics. It's a self-review threat. If you feel that that threat is not there, if your amount of loan is not really a material amount, you can go for that. But my personal view is that it's better that one shouldn't take up the assignment. But it's again a self-review threat. Nothing bars you for that, and it doesn't recognize between a normal loan and a loan against FD of the bank. It doesn't distinguish between that. So whatever rule you are applying for any bank loan availed by you for at other branch, same logic will apply to you. What if the bank does not debit the interest on the date when it accrued, but after 1 or 2 months? What should be the date of default or asset classification? See, if the bank has skipped interest, debiting the interest in a particular account, you need to presume that the interest was debited on the respective date, and then consider calculating the NPA applying the NPA classification norms. it shouldn't happen that the bank should apply the interest after 1 or 2 months. The delay is something which is not supposed to be there. If a bank delays that, it shouldn't affect my asset classification norm, because I will presume that how the account status would have been if the interest was debited on the respective due dates. So I will classify my account based on that concept. It is suggested that central auditors are to respond for the MOCs issued by branch auditors. Branch auditors are in dark about fate of MOCs issued by them. There is nothing like that. And see, as far as the branch auditor is concerned, once the branch auditor passes an MOC, or rather to be specific, gives a report, the responsibility of the central auditor will start. So what happens with MOC is something which will be taken care by the central auditor, and one should not be really bothering about what is the fate of MOC issued by a branch auditor. As far as my experience goes, MOC is never dropped by central auditors. It is always factored in. So there is nothing like MOC is not considered, or auditors are kept in dark. Practically, central auditors cannot respond back to each and every auditor. So we need to factor in the practicality of that also. Our branch auditors sensitize with IFCOR, and as a central auditor, how to reply to branch IFCOR. See, as far as sensitization of branch auditor is concerned, or even central auditor is concerned, Institute has already issued a publication on IFCOR. It was issued in last year, that is 2021. It still holds good. A soft copy is available. Hard copy, I presume that it is out of print, but soft copy is very much available. So what is expected is that if you are a branch auditor and you're performing the testing of IFCOR, you're supposed to at least go through the publication, understand that what is the concept, and then only undertake the verification process or the testing process. As far as CSA is concerned, CSA needs to ensure that there is a clear-cut instruction passed on to the branch auditor as to what kind of testing the branch auditor is supposed to do. And if there is a clear-cut communication from CSA, I don't think that at the branch level there will be any issue as far as IFCOR is concerned.
Those were the questions.
Okay.
So, Naresh, over.
If anyone is having more questions, they can post it, or
Yes, sir. If they post it in question box, or else if they write us a mail, we'll send it over mail to you, sir.
yeah, exactly.
I think, friends, we had a detailed discussion by CA Dhananjay Gokhale. He has discussed on various latest circulars with reference to the central auditors and branch auditors, and all the changes that were very relevant for the assignment for this March 22, with various circulars, IRAC norms, circulars relating to investment portfolio, documentation, ECOFAR, various areas he's mentioned. And I'm sure as a central auditor, because the role and responsibility is very heavy, and the amount of documentation that is required in terms of peer review as well as
No problem.
various other regulatory requirements, I think members would be ready. Sir, there's one question regarding this ICOFAR, as you mentioned. When the technology and the whole details are available at head office level, how can a branch auditor issue a certificate saying that ICOFAR is being applied at branch level? Are they not commenting something which is beyond their scope? I think it's better fit for a central auditor to issue a certificate.
No, sir. Actually, there is a bifurcation.
Yeah, please go ahead.
Yeah. So typically there is a bifurcation which is done between what is tested at the branch level and what is tested at the head office level. It's not that the branch auditor tests the entire IFCOR at the branch level. It's only confined to limited points. And that's why I said that what is expected by the central auditor is that they need to give a clear-cut instruction as to what they are expecting from the branch auditor. Once that is done, actually, it's not a far-stretched job, because then they have to test within the ambit of the branch operation, nothing beyond that. So that's what is expected from the branch auditor.
Right. So fine. Thank you very much, sir, for sparing your time and addressing our members on this topic of Treasury and Treasury audit and capital adequacy norms. So it was very nice of you for spending time. I'd like to thank CA Ranjit Agarwal ji, CA Amarjit Chopra sir, and CA Dhananjay Gokhale ji for coming and sharing their thoughts, views about various circulars and various impact of for our central audit. And also, I'm sure a lot of branch auditors also were registered for this event. Friends, tomorrow also we have another session of bank audit. We have a session where at 10 o'clock in the morning, so where we'll have sessions on red flags and early warning signals, and the role of in terms of refacement and restructuring, and also in terms of recovery of these loans. So I think there's another set of session tomorrow. So I request members to register and participate in that session. Thank you, Gokhale ji, for sparing your time again from Madurai, despite having a big schedule today in the afternoon. I think you had spent enough time on sparing your time and sharing your thoughts. Thank you very much. Thank you all members.
My pleasure. Thank you. Thank you.
Thank you.